Hey everyone, I welcome you all to this new video on this new chapter of equity valuation and bond valuation. This chapter was introduced for the first time in CMA Finals and it is a bit important. It's easy also. But first, before I start this, let me give you a bit of comparison. Remember, in valuation of equity share, there are a few methods to be followed. Valuation of equity share is a bit complex as compared to bond valuation. The reason is pretty simple. Equity share, the dividend is not fixed. It is not predictable. If the company has profit, it will give. If it does not, it will not announce dividend. But in case of bond valuation, the rate of interest is fixed on your debentures. So to start with this concept, I need to take you to your CMA Inter also, because there are few concepts which were there in your cost of capital chapter and your dividend policy chapter, which are of great importance in this video. Okay, chalo. Before I start, equity valuation, a few concepts first, and that is meaning of some abbreviations. We start with this. P0, market price per share. D0, that is your current dividend. D1, that is your expected dividend, also called as your future dividend. Very simple. Okay. Now there were a few models, if you remember, in your dividend policy. One was your Walters, one was your M&M, one was Gordon's. The Gordon's model is supposed to be used over here. Now in the entire chapter, we are supposed to divide into two concepts. One is your discounted cash flow and one is a relative approach. Okay. Now before I start this, let me give you a brief highlight on what exactly we are supposed to do. In the entire chapter, we are supposed to compute the price of share, that is P0. Okay. Now, how are we supposed to do this? So, you need to compute P0, that has to be on the left hand side. Now, for example, if I have to break up this chapter, the few methods are your normal constant approach, constant dividend approach. One, you have your constant growth dividend approach. Other approach has to be your EPS approach. Other approach has to be your PE approach. And the net assets is your last approach, which is there in this chapter. Okay. Now, what are the formulas for the same? Very simple. First, P0 is equal to D1 upon KE. That is pretty simple without any growth. Here, P0 is D1 upon KE minus G. You might be able to recollect these formulas which were there in your CMA intermediate. EPS, P0 is EPS upon your cost of equity. Okay, that is the required rate of return. PE, I hope you know the formula for PE, price earning. So I'll write the formula first. PE is nothing but MPS upon EPS. Okay, if I write this formula, you only tell me you are supposed to compute the market price per share. So how will I make a formula? MPS is equal to EPS into your PE ratio. You will get what? Your market price per share. And net assets is nothing but what? How will you find out the price over here? That is the net earnings available to equity shareholders divided by total number of equity shares. Okay. So in all these things, you can compute the formula and you can also compute the price of equity shares. Okay. Chalo. Now we'll do one thing. We'll take a sum one by one. And remember, there's one more concept, and that is the most important. Like if you get hands on that concept, everything is all okay. Okay. Sorry for the fireworks. Okay. So there are a lot of fireworks in and around the area. So please bear with me the sound. Okay. Okay. Now see, if at all if there is any question on these formulas, it is very easy. You only simply need to put the figures in this, you'll get the answer. But there is this one concept which is there on relative approach. And what is that? I'll tell you. Okay. I'll give you an example first, then we'll solve the formulas and all that. Okay. See, this is a timeline: 0 year, first year, second year, third year, and fourth year. I'm just giving you an example. Okay. Let us say there was dividend in all these 3 years at rupees 10 per share. And they tell you that from the third year onwards, the dividend is going to be increased by 10%. So what you will do, you'll do 10 plus 10%, it will be 11 over here. Plus 10% you will do, because it is increasing by 10%, okay? 12.1 and so on, it is infinite. Now, in this approach, you are supposed to compute the value of share. Now, this is a bit complex. Why? Because see, You have no idea till where it is. You have to convert your perpetual cash flows into a finite cash flow. That is number one. And you need to discount also, because you're supposed to compute the value of share as of year zero. So what I'll do is, see, from year it is increasing, right? So what I'll do is I'll compute the price at year 2. See, I'll write here P2, okay? And what I'll do, what is the formula? So it is D1 upon KE minus G. So what is D1? Like the next year dividend. And what is that? The dividend for the third year, okay? And now I will write KE minus G. I'll compute some price over here. There will be some price, okay? Okay. Now this has to be discounted by the discounting factor for the second year. So there will be an answer over here. Plus they will be discounting of this, and that will bring you to year 0. And this will be your final answer. If you've understood this approach, the whole chapter is nothing. I'll repeat myself again. They will give you some question. In that they will tell you from this year onwards the dividend has risen, or there was no dividend, it was 0, and the dividend has picked up from year 2 or 3. So what you have to do is, whenever the dividend is picked up from which year, you need to compute the price at that year. So in my example, from the third year onwards, there was dividend increase by 10%. Infinite. So what I did, I need to convert it into a finite cash flows, okay? FINITE. So what I do is, I compute the price at this, where it is starting, okay? So what I'll do, P2, and what's my formula? D1 upon KE minus G. D1, that is the expected dividend. An expected dividend of the third year. So whatever it might be, I'll write here D3, and that is obviously 11, we have it over here. Upon KE minus G. You'll get a figure over here. Now discount it with the discounting factor for second year. And then these two dividends will be discounted at respective discounting factors for year 1, year 2. And what all summation you will get, that will be your answer. And that will be your fair value of share as of today. If you've understood this, chapter is nothing. Okay. Now, we'll do one thing. We'll go through some sums. I hope you'll understand this. Pay attention. Okay. Chalo. Number 1. Very, very simple sum. Very simple sum. Okay. These are all your basics from your CMA intermediate. See, the current price of a company share is rupees 70. Okay. The company is expected to pay a dividend of 4.20 per share, increasing. See, what is expected? Tell me what is expected. That means this is D1, rupees 4.20. Okay. Annual growth rate of how much? 5%. Okay. Investor required rate of return is 10%. So I'll write here KE, that is 10%. Should he buy the share? So why is 70 given over here? So that you can make a decision out of it. Okay. So we'll give a simple example, simple formula. P0, the dividend growth approach, D1 upon KE minus G. What is D1? Already given, 4.20 upon your 0.10 minus 0.05. Can you please compute and tell me how much is it? Divided by 0.05. Your answer has to be rupees 84. 84. Now you only tell me whether you will buy the share. See, now the current market price is 70 rupees and the fair value price which you have computed is 84. So is the price going to increase? The answer is very much yes. So will you buy the share? The answer is affirmative. Okay. Do you understand this? So these all questions are going to come, but I have taken all the variety of sums. So basically this was one normal approach. One I have taken of net assets approach. Compute the value of equity share from the following. So they've given you tons of information. Equity share capital, reserve and surplus. They've given you 2 loans, fixed assets, investment, operating profit. That's your EBIT. This is your EBIT. Okay. Next, tax is given and P ratio is given. Okay, they're telling you to compute the value of equity share. Now which approach you will use? It will be net assets approach. What is net assets? Net earnings available to equity shareholders divided by total number of equity share. That's all we have to compute. Now when you will start this sum, the first thing you need to do is what? Compute what? The net earnings available. I'll start my statement. I'll start with EBIT. How much is EBIT? It is given 25 lakhs. It is given 25 lakhs minus I will do interest. Now we have 2 interest. Okay. One is 15% on and 25 lakhs and 12.5%. So one will be on secured loan and one will be on unsecured loan. Just see how much is it. 25 lakhs into 15%. This will be 3,75,000 and unsecured it will be 30 lakhs into 12.5%. This will be again 3,75,000. Okay. Now EBIT minus interest. Next, you will get something called as EBT. Do it. 25 lakhs minus 3,75,000 minus 3,75,000, you will get 17,50,000. 17,50,000 less tax at the rate 30%. Tax at the rate 30%. How much is it? 5,25,000. Very simple. Minus this, how much is the figure? You will get 12,25,000. This is nothing but EAT. Just find out if there's any preference dividend. There is no preference dividend as such. Okay. No. Okay. Now what you will do after EAT? These are the earnings after tax. Okay. Now you have to divide it by the number of shares. How many number of shares are there? So 50 lakhs is the amount, and divided by how much is this? 20 each. So you have 2,50,000. So your EPS will be how much? 12,25,000 divided by 2,50,000. Okay, how much is the answer? 12,25,000 divided by 2,50,000. This will be rupees 4.9 is your EPS. 4.9 is your EPS. Okay. Now what you will do? You need to compute the value of share, right? They're giving you PE ratio also. It's 12.5. So it's very simple for me now. What I'll do? PE I'll write over here. I know the formula already. That is MPS upon EPS. I need the MPS in that. P is how much? It is 12.5, right? 12.5. 12.5 is equal to X. I don't know what is this. 4.9. So 4.9 into 12.5, you will get 61.25. Market price per share is rupees 61.25. That is your answer. Which was this approach? This was net asset approach. Okay. The first sum which you did was dividend growth approach. Are you understanding this? Chalo. Next sum we'll go. Oh, this is a wonderful sum. Please bookmark this, huh? Please bookmark this. Okay. A company has a book value per share of 137.80. What I'm telling you, it has a book value per share. You need to solve the sum before if it comes in the examination, you don't understand what is it. I'll tell you why. See, it has given a book value of 137.80. Its return on equity is 15%. Okay. It follows a policy of retaining 60%. What's retaining? That's a retention ratio. Like out of 100 rupees, if I'm retaining 60, I'm giving out 40% as dividend. Okay. And the opportunity cost of capital is 18%. What will be the price of share today? Beautiful sum. See how to start this sum first. Okay. Understand what is it. One sec. So what you'll do first? First, you understand return on equity. What is the formula for this? It's earnings divided by book value. So what I'll write is, I'll write your EPS divided by book value per share. That's the formula for what? Return on equity. Return on equity. Okay. Like basically how much you're earning as compared to your what book value. So can you please tell me what all is there in this? What all is there in this? So we have return on equity is 0.15. Okay, I have no idea what is the EPS, but I know what is one book value, 137.80. Can you please compute the EPS for me? Into 0.15. My EPS will be rupees 20.67. My EPS will be 20.67. Okay, sir, we need to compute the price of share today. Okay, now these guys have written, they have a returning 60%. Remember one thing, there is no growth mentioned over here. So do you remember the Gordon's growth policy in a CMA intern? So Gordon had invented a formula for growth, and that was B into R. What is B? B is nothing but retention ratio, 0.60, and my R is 0.50. That's my return on equity. So I'll get something into 0.15. I'll get 9%. I'll get 9%. Okay. Now, so can I compute the price now? Yes, I can compute. So it is P0 D1 upon KE minus G. Now, can you please tell me how much is my D1? So dividend is not given, but can I compute dividend? Yes. How will I compute dividend? See, dividend is always computed from earnings. See, earnings. See, I'll tell you. How is dividend computed? Dividend is computed like this: earnings per share, which is EPS, into your dividend payout ratio. See if you can understand this formula. Dividend will come out from where? From earnings only. So if my earnings are 100 rupees and my policy of the company is to distribute 60%. So what I'll do, 100 into 60%. In the question, they have already mentioned that the company is retaining 60%. What is the indirect meaning? That the company is giving out how much? 40%. So do I have the earnings? Yes, I have the earnings. So what I'll do is, earnings was how much? Earnings was 20.67. So what I'll do here is rupees 20.67 into how much was the dividend payout? 40. Retaining is this much, the 40 is this much. 40%, which will give me D1. So please see how much is it? 20.67 into 40%. So this will come out to 8.268. Sir, what is this? This is my D1. Okay. Now please go over here. 8.268 upon how much is my cost of equity they've given you, that is 18%, and you've already computed the growth, that is 9%. 0.18 minus 0.09, that's your answer. Okay, how 8.268 divided, 8.268 divided by 0.09, how much is it? 91.87 approx. Are you understanding this? So this is your price of share. Okay, this was this sum. Next, this is a very good sum, very good sum. Okay, mark all these questions. I'll upload this on the drive. Okay, the sums. You can also solve the module sum, but those are very easy. Like you just go through it, you'll understand what we did in the first sum. No, same thing is there. Okay, but I've taken these sums which are outside your module. Okay, now first, A Limited just paid dividend of 13 per share. As a part of its major reorganization of its operation, it has started that it does not intend to pay dividend for the next 2 years in 3 years' time. So basically, this company is going to reorganization, okay, like restructuring. It will commence paying dividend at 10 per share, and directors have indicated that they expect to achieve dividend growth at 12% thereafter. Okay, so they're telling that they don't have any intention of paying dividend in 2 years. They'll start paying dividend after 2 years. Okay, done. If the reorganization does not take place, okay, dividend will be paid in the next 2 years, and expected dividend growth will remain at the present level of 6%. Cost of equity is 18%. Calculate the value of firm shares in both situations. Okay, so can I do one thing for you? What I'll do is, first, we'll write here. If reorganization does not take place, because that will be very easy for me to compute, does not take place. Okay, see, if the reorganization does not take place, what I'll do is, and you just need to compute the price, right? So P0 D1 upon KE minus G. See, dividend will be paid in next 2 years. Expected dividend will remain in the present level, how much? 6% per annum. So what I'll do is, see, so 13 per share is the dividend. So what I'll do is, 13 plus 6% I'll do, 13 plus 6%, that's the growth rate. So I'll get 13.78 upon cost of equity is how much? 18, 0.18, and my growth rate is 6%, 0.06. Okay, how much is the answer? $114.83. This is if the reorganization does not take place. Okay, now the main point is situation 2. If reorganization takes place, now I want everybody to pay attention. If you understand this, no, khatam, chapter is over. Okay, see, I'll draw a timeline, very simple. See, 0, 1, 2, 3 and 4 and so on. Okay, so what have they told you is they don't have any intention only of paying dividend in the next 2 years, in 3 years time. So what I'll do is, I'll write here. So this is like now 0, this is 0, this is 0. What is 0, 0? Dividend. They're not paying dividend. Okay, but it will commence paying dividend at 10 per share, and directors have indicated that they expect to achieve a dividend growth at 12% thereafter. So what I'll do is, see, listen, I'll write here 10. This is my dividend 3. See, I'll write it D1, D2 and D3. You tell me what is D4 here. What is D4? Sir, 10 plus 12%, right? They are like giving out 12%. 10 plus 12%. This will be 11.2. Sir, can I write for 5? Yeah, if you wish, you can write for 5 also. There's no problem at all. 11.2 plus 12%. How much this will be? 12.54, and so on, so on. Okay. Now they are telling me to compute the price of this. Are Baba, thereafter they are telling this is the infinite. Now how can I do? That's what I told you in the first place when I started the video. And this is a shortcut trick. Understand, if you understand this very calmly, I'll go very slowly. Did you understand this now? The first 2 year dividend is zero only. They have only told. When is the dividend started to pick up? Can I say it is start to pick up from here? At the year, like end of year 2? Because next year they have paid 10. That's the point where it's still starting. Okay. Now what I'll do, see. Now understand this. I need to compute the price at the end of year 2. How will I compute the price? What's my simple formula for P0? D1 upon KE minus G. D1 stands for expected dividend in the next year. So what is the expected dividend in the next year? Like dividend 3. So this is the formula. D3 upon KE minus G. Okay. Do you agree with this? D3, 10. KE, I think it is, wait, I think it's 0.18, right? One sec. Equity is 18%. So I'll write as 0.18 minus. How much is the growth? How much is the growth? Can I write as 0.12? So that's the growth rate right afterwards. So how much is the price over here? How much is the price? Is it rupees 166.67? This is the price at the end of year 2. Now what have I told you? What have I told you? The moment, is this the price as of today? No, boss. This is the price at the end of year 2. But you have to compute the fair value when? Today, zero. You need to bring that into present value, right? How will you do it? So, simple. Discount this figure by what? Discount this figure by what? Discounting factor for year 2. Year 2. Okay. Now, discounting factor for year 2. How much is the cost of equity? 18%, right? So, do 1 divided by 1.18 is equal to. This is 0.7181. This is your answer. 1.67. And my answer will be rupees 119.69. See whether you are getting this answer or what. Now see, I'll tell you what could have happened more into this sum. Okay. This is the final answer. Finished. This answer is over. But what extra calculation I would have done if there was a twist in the sum? If there was any dividend amount over here, any amount, then I would have to compute the present value of that 2 dividends also. Then my entire addition, my fair value will be what? This figure plus that 2 present value figures of dividend. But in this sum, it is what? 0. Why will I compute? So this is my final answer. Now you tell me, if the reorganization does not take place, how much is the price? 140. How much is the price if reorganization takes place? 119.69. So you will go ahead with the reorganization. Follow this concept for all the sums. This is the most easiest concept which I have told you. I hope you have understood this. Book value. This I have taken. Equity bond. There was one more sum. 1 second, please. 270. It's a bit complex, but still I'll take it. Okay, just for your understanding purpose. Morgim Limited has an investment opportunity available which will involve a capital outflow in the next 2 years. That is shown in the table only. 1,000, which will produce benefits during the following 3 years. Like from this is outflow, and from here inflow is starting. Summary of the financial implication of this investment is given below. Morgim Limited currently has 1 lakh shares in issue. Okay. Dividend just paid was 15 per share. In the absence of above investment, dividend are expected at the same level at the next 3 years. Okay. Which then demonstrate perpetual growth of 10% per annum. Morgim Limited is currently all equity finance and required rate of return of equity is 18%. And has a long established policy of not using any debt finance. Okay. Because of the current depressed state of the stock market, it could not in the near future issue new equity because there is nothing available in the market only. The only possible way of financial the investment is therefore reduced to the dividend payment. Like reduce the dividend payment, so you'll get more cash flow. Okay, cash received from the new investment will be distributed, and growth in dividend is 10%. Will also be maintained because of other operation. Calculate the current price of the current price of the company, and second, compute the share price after the investment accepted, assuming the market knows of the dividend changes that will result from the investment using a dividend discount model. Okay, so first things first. Okay, it's very simple. How will you do it? How are we supposed to do this? Like, can you just try to do it? I'll wait for 2. I'll just have a sip of water. Can you just compute and try it? Like, have you at least started doing this? If you're thinking how to do the sum, so first we'll do the current value of share, okay? See, listen. So first I'll make a timeline, okay? See if you can do this over here. Now, if I have to explain this, see what are they telling? The dividend just paid was 15 per share. In the absence of our investment, the dividend expected at the same level for the next 3 years. So they're telling D1, D2, D3, D4, and so on, D5. Okay, 15 rupees, 15 rupees, 15. They are telling same dividend it is. After that, what is happening? Then there's a perpetual growth of 10% per annum. No problem. I will add 15 plus 10%. How much is this? 16.5 plus 10%. How much is this? 18.15, and so on. Like, I'll just write it. D6, how much? Plus 10%. How much is this? 19.96. Now, Are Baba, you tell me, how will you compute the price? What I've told you, from where it has picked up, Are Baba, from here it has picked up. So what I'll do, price at the end of that year is nothing but D4 upon KE minus G. Is this right? 16.5 upon, how much is the cost of equity? 18%, 0.18. 0.18 minus 0.10. See how much is the answer, please. See how much is the answer. 16.5 divided by 0.08. I'll get something called as 206.25. Now. Simple. You know the concept, right? Shortcut trick. So whenever I compute this now, I will discount it by this figure. Like third discounting factor, 18% is the discounting factor, third year. But ladies and gentlemen, there are figures over year and year also. So you need to discount that also. I'll make a few table. Very simple. I'll see what I'll do. 1, 2, 3 and 3. I have normal capital budgeting discounting. So what I'll write here is, see how much is the dividend? How much is the dividend? Dividend, and this is the price at the end. How much was dividend? 15, and this is 206.25. Can I write a discounting factor? Yes, absolutely. Same, your NPV table, boss. NPV table. So 1 divided by 1.18. How much is this? 0. One second, what is this? 8475 is equal to 0.7182 is equal to 0.6086. Same discounting factor for down? Yes. See what is the answer? That is your answer for the first question. Very simple. 15 into 0.8475 m plus 15 into 0.7182 m plus 15 into 0.6086 m plus and 206.25 into 0.6086 m plus MRC. How much is the answer? 158 something, 158.13. Are you getting this answer? Are you getting this answer, everybody? Okay. You might be thinking, why is he looking up? The reason is I've installed my TV very upstairs. Okay, I'm in some another classroom now, where I used to record the first lectures where we used to go live. The TV was like this, so I used to look like here. But this TV is way upper. That's what I'm looking at. If you're thinking why on earth is he looking up? Okay, done. Second concept. Second. So now what they are, see the second thing is calculate the share price after the investment is accepted. Okay, assuming the market knows of the dividend changes that will result from the investment using a dividend valuation model. Now see, what they're telling is that like you don't have anything now, you cannot issue new shares, there is depressed state in the market. So the one thing which you can do is you can reduce the dividend only. See where it is written, reduce to the dividend payment. So what I'll do is second question, I'll write I'll prepare a table. So see how will I do it here. Next, existing business, your new investment was also there, new investment. Next is your net amount. I'll tell you what is this. Next is your discounting factor at 18%, and this is your DCF normal. Okay, so 2, 3, 4, 5 and 5. Okay, now understand this first. Okay, see your new investment, where's the question? See, I'll take this in thousand, this is lakhs. Okay, so what I'll do is this is already in negative, it is 10 only, 10. And next your inflows are there. How much is the inflow? 1 13 31, 1 13 31. Remember what I'm doing now. Your existing business was how much? It was 15, right? 15, like, no, you're not giving out dividend, right? So you are not reducing it. So that's your basically inflow. That's what the logic is. 15, 15, 15, 16.5. Next was how much today? 18.15. Okay, now remember one thing. Now what I'll do here is, what's your net amount? 5. Like 15 is saved. No, 10 is going. 5, 16. That's your inflow. Now 16.5 plus 13, 29.5, 18.15 plus 31. This is how much? 49.15. Their discounting factor will come. But I'll tell you one thing now. What is going to happen? I'll prepare a timeline. Pay attention now. Now the point is, this was your new investment. I'm seeing here because my question is over here. Net. Don't need to scroll it up. New investment and your net investment which you already have. Okay, now you tell me one thing. Your first year there was a outflow of like 1000, right? 2, 10. Third was how much? There was inflow of 1. Here it was what, 13, and here it was how much? 31. My net as in what? If I do not give out dividend, how much is my inflow? Okay, so the first, so net amount I'm writing on, this is not existing, this is a net, this figure I'm writing over here. Okay, see, my first will be 5. Next you have your 16, next you have 29.5, next you have 49.15, and last you have is how much? One second, let me check. Where it is. Now what I'll do is one sec. Where's my dividend amount? 18.15 plus 10%. This is 19.96. Because that's the only figure over there, because there is no cash flow over there, and that is after perpetuity is going on. So what I'll do is, this is first, second, third, fourth, fifth. I'll compute the price at the year. Now remember one thing, what I'm doing now. Dividend, that is 19.96 upon 0.18 minus 0.10. That is perpetuity. No, we have to stop it somewhere. That is why compute the price 19.96 divided by 0.08. This is 249.5. This is discounting over here. That's why I will write the net figure. Where's net figure? 249.5. 249 point, how much is this? 5. And now you do one thing. Now discount this by 18% and see what is the final answer. You have to discount it with discounting factor. Your final answer has to be somewhere out about this 163.33. Just discount it and just see what is the final answer. This is the answer to your second question, second sub question basically. Okay, remember, wherever there's a perpetuity growth, like from there it is starting, then you have to stop. Then that is your cutoff point. Then for there you will compute the price, but that is way ahead. Then you have to bring it back to the present situation. That is your fair value. So in this, your first figures were there, and this we computed the discounting factor with this. Okay, this there was nothing over here, but there was no cash flow only. That's why we computed over here, and this will be your final price. See if you're getting this or what. You can easily solve your sums from the module. There are very few sums actually, but these sums are not there in the module. Okay, and this sum which I've taken, it is only for extra extra purpose. Okay, but did you understand the concept? Where it is taking off, stop there only. Where the plane is going, stop there. Compute the price there only. Like third say it is starting, P2 only you start, and dividend will be next year. K minus G, finish. And then discount it with what? That year only. One concept. If there is dividend paid into, discount that also, and prepare an NPV table only. If you prepare NPV table, you will get the answer immediately. And the first basic is very simple. Your constant approach, your dividend growth, your earnings, and your net asset that I have taken. Okay, so very simple. P0. There are only 2-3 formulas here. P0, D1 upon KE minus G, one formula. Second is what? If they ask you what net asset, that also I've shown you. Net earnings available to equity shareholders divided by total number of share. PE formula. P is nothing but what? MPS upon EPS. So how will I get a price? EPS into P ratio will give me price. As simple as that. Okay. Chalo, we'll stop here. Just do the sums from the module. It will be more than enough. But understand this concept. This is very important. Okay. Thank you.